No matter how much stock prices might swing on any given day, one of the best parts of being a dividend investor is not having to worry about the day-to-day share price movements of my holdings. Because what's more important than the share price movements of my holdings is their ability to continue to pay me consistent dividends. In this Patreon requested video, we're going to examine even more high-yielding dividend stocks out there that have never gone through a dividend cut. To my knowledge, I've never gone in-depth on any of these before, so these should all be new mentions and potentially new holdings if you're looking for some high-yielding opportunities. And while I obviously can't guarantee these companies will never cut their dividends, up to this point they all have pretty impressive track records. So with that being said, let's get started. The first company we'll look at is National Storage Affiliates Trust, ticker NSA. They're a REIT that's focused on the ownership, operation, and acquisition of self-storage properties typically located within the top 100 metropolitan areas in the United States. As of September 30th of 2023, this company held ownership interests in and operated 1,119 self-storage properties located in 42 states and Puerto Rico with approximately 73 million rentable square feet. NSA is one of the largest owners and operators of self-storage properties among public and private companies in the US. This REIT's been around since 2013 and currently yields around 5.8%, and they're one of the smaller self-storage REITs that exist. National Storage currently has a market cap of $4.6 billion, whereas CubeSmart has a $10 billion market cap, and Extra Space Storage has a market cap of over $33 billion. Despite its small size, NSA has had a really decent amount of success up to this point. Looking at their dividend history, we can see that they've never cut their dividend since their IPO. Their dividend growth is a little inconsistent. You can see that they've had periods where they've increased their dividend for 5 quarters in a row, sometimes even by a pretty sizable amount, but then they'll go several quarters without growing it, or the increases will be very small. This company last grew their dividend 6 months ago by a penny, but more recently things have slowed down for this REIT when speaking about growth. You can see their share price peaked in early 2022, but it's been going down since then because of high interest rates and probably due to their slower growth in the last couple of years. Looking at their AFFO, which for REITs is one of the most important metrics on their income statement, you'll notice that they were growing pretty quickly up until early 2022. According to their website, in 2021 their company had roughly 1,000 properties, and as of last quarter they currently have 1,119 properties. So in the last 2 years, it looks like their management team has basically slowed down significantly with their acquisitions of new properties. With their last AFFO per share being 67 cents and their last dividend declared being for 56 cents, this gives their stock an AFFO payout ratio of 83.5%. This is a little higher than what's typically considered conservative for an equity REIT. Many like to stay between 70 and 80%, so there is a little more risk involved with this self-storage REIT in my opinion. Their website highlights 2 main reasons for considering investing in NSA, or really most self-storage REITs out there. First, they have a history of outperforming other REIT types and even the overall market. Now, the downside is that most of these types of REITs don't offer high yields if that's more important to you. Before interest rates were so high, companies like Extra Space and Cube were only offering dividend yields of around 2 to 3% on average. They're higher now because the REIT sector is still largely discounted, but they usually don't offer yields this high. Instead, the outperformance has largely been due to share price growth. The second main reason is that self-storage businesses are much more recession-proof. Unlike offices and hotels, there's always a need for these kinds of businesses no matter what state the economy is in. So you can see there's a couple of really appealing reasons to hold these kinds of companies. Not all of them have been great investments though, with Global Self-Storage being an example of a poor-performing company in this field. But National Storage Affiliates Trust might be a good consideration for those looking for a dividend holding with consistency. The next company we'll look at is MPLX, ticker MPLX. This company owns and operates midstream energy infrastructure and logistic assets in the United States. They're involved in the gathering, processing, and transportation of natural gas. They're also involved in the gathering, storage, transportation, and distribution of crude oil and refined products. They were incorporated in 2012 and they operate as a subsidiary of Marathon Petroleum Corporation. There's a lot of really good things I like about this company, but I have to give a disclaimer. MPLX is a master limited partnership, which is a unique type of company that comes with special tax considerations. When you invest in an MLP, you're considered to be a partner in the company, not a shareholder like most stocks. Shares of an MLP are also referred to as units, again different from being a shareholder. When you hold an MLP like MPLX, you'll get a special tax form that you'll have to file with your income taxes called a K-1. These are difficult forms to handle if you're not a CPA, so you'll either likely have to hire one to do your taxes or use tax filing software. These services always charge more dealing with K-1s, so be sure to keep all this in mind if you are considering an MLP. Apologies for the long disclaimer if you're already familiar with MLPs, I just hate seeing people recommend them on YouTube without talking about the tax implications. I've seen people get K1s unexpectedly after they've already filed their taxes, and it's a problem for them. But back to MPLX, this company has had a really good amount of dividend growth. They announced a dividend increase of 10% back in October, and they've grown their dividend every year since going public more than a decade ago. You can see this company did have a rough year in 2015 due to the company merging with Mark West, but since then things have been a lot smoother for them. Their units currently come with a dividend yield of 9.2%. MPLX is a company that's really focused on growth. They have this slide in their most recent investor presentation that shows their most recent projects and how much their distributable cash flow has grown each year. Their DCF, which is how much money a company has left over that doesn't need to go to any obligations, has a compound annual growth rate of 6.8% over the last 4 years. In fact, their last dividend declared of 85 cents was 160% covered, which is extremely safe, especially for MLP standards. MPLX is currently the third largest master limited partnership with a market cap of almost $37 billion according to Seeking Alpha. Ultimately, if you don't mind the tax situation, MPLX has been a really solid energy company. If you're not a fan of MLPs, another energy company I hold and continue to be a fan of is Enbridge. That's if you don't want to go the MLP route but still want some big dividends in the energy sector. Another high-yielding investment that's never cut their dividend is Broadstone Net Lease, ticker BNL. They're an industrial-focused, diversified net lease REIT that acquires, owns, and manages primarily single-tenant commercial real estate properties that are net leased on a long-term basis to a diversified group of tenants. BNL says they focus on establishing long-standing relationships with creditworthy tenants who occupy properties with strong real estate fundamentals. Although they have been around since 2007, the company didn't go public until 2020. Right now, their stock currently yields about 6.8%. I hesitated including this company in this video since they've only been around less than 4 years. That's not exactly impressive when it comes to not cutting your dividend. But going over their website and financials, I think they are worthy of mentioning here. Broadstone Net Lease really highlights all over the place that they're a defensive growth company. It says on their homepage, Broadstone is an established net lease REIT with a proven diversified strategy focused on the acquisition of mission-critical single-tenant commercial properties nationwide. We strive to deliver dependable results for all of our shareholders over the long term. If there's one thing this company wants you to know based upon everything that I've read on their website, it's that they really value defense and safety. So in other words, I don't ever want to see a dividend cut from these guys since they claim to have such a defensive portfolio. To be honest, it does look like they have a pretty good property portfolio, with 51% currently being in industrial properties. Their next largest sectors are healthcare, restaurants, and a small amount of retail and office properties. It looks like their largest office tenant is a college in Florida, which I'd have more confidence in than if it were a call center or some kind of mixed-use office building. Since this stock had its IPO, they've grown their dividend twice a year every single year without fail. According to their latest results, they have a dividend payout ratio of 73%, which is considered safe for this kind of REIT. The good thing about industrial REITs is that just like self-storage REITs, they also do pretty well compared to the majority of other types of REITs out there. So with all these things considered, I thought this would be a good stock to feature on this list. Despite it still being a small company with only 800 properties, their WALT is 10.5 years, which is excellent. Industrial tenants tend to have much longer leases than retail and restaurant locations. Their occupancy rating is 99.4%, which is also much higher than average, and they have a 2% rent escalation rate, which is also really good. And with that being said, that's going to conclude our look at some more high-yielding dividend stocks that have perfect dividend track records. Let me know if you'd like to see more of these, and I can feature some other companies that have never reduced their distributions. But yeah, thanks a lot for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.